Bill Taranto is a president of the GHI Fund and responsible for all areas of investing. Bill has more than 25 years of healthcare experience, including over 15 years of healthcare investing. In addition to his experience in venture investing, Bill has more than a decade of management operations experience. Today, Mr. Taranto is a member of the Merck Innovative Ventures Board, a group that manages the identification and funding of portfolio businesses, and is also chairman of the GHI Fund LLC Management Board. Prior to joining Merck, Mr. Taranto spent 18 years at Johnson & Johnson in various venture capital, marketing, sales, and business development roles. Before J&J, Mr. Taranto spent 8 years in investment banking and as a Bachelor of Business Administration from St. Bonaventure University. I hope I didn't say too bad with my French accent. Bill, the stage is yours.
Thanks. All good. Well, good morning. As I said, my name is Bill Taranto. I'm president of the Merck Global Health Innovation Fund. And get forward here. So what I'm going to talk to you today about is, look, we're in the middle of some really rough waters and tough financial times, what's going on in the market, and especially for our community and our portfolio companies. And what I want to go over today is, a little bit about some stats in the market, but with proper planning, you can actually navigate what's happening in these troubled times. But it does take planning and takes proper sort of thinking of how you want to move forward. And so the idea is to give you some tips on how to do that moving forward. But first, I just want to start with some interesting stats. Look, we're seeing lots of headlines. We see headlines about down rounds, headlines about cram downs. We see headlines about European VCs pulling back capital. We're seeing headlines that there's lack of exits. We're seeing headlines that there's just no capital within the market. And what's not up here is the headline about the recent closing of SVB Bank. But why that's timely or why it's important for this talk is that it kind of upset the whole debt market. What happened in 21 and 22 is companies raised capital at really high valuations that weren't really supported by their P&L. So in 2022, what happened was a lot of insiders like myself raised debt. But the problem with raising debt is all we're doing is kicking the can down the road. And all that debt's coming due in 2023. But the problem is, unless you have a spectacular P&L, you're not going to, you'll be able to get debt, but the cost of that debt's going to be really high. And if you don't have a spectacular P&L, you're not going to get any debt at all. So what does that mean for you to raise capital? And that's the problem we're having, is that all these companies are trying to raise capital at the same time. So what else is happening? So at the end of 2020, this is from Pitch, but at the end of CB Insights, at the end of 2022, what we've seen is that IPOs, SPACs, and M&A is down 95%. So if you have a company that you want to bring to the U.S., or you already have a company that's in the U.S. and you want to exit, that's not happening right now. It's just a closed market at the moment. And so that's starting to cause a lot of problems about how do we unload some of these companies that are good companies but just can't seem to exit right now because there's just no market for it. And then what we're seeing is it's just that in the U.S., and especially for healthcare where I work, fundraising is actually down. And so partnerships are going to be critical. And the problem that we're facing as well, which is very relevant on the next slide, is that even in Europe, we're seeing fundraising down by 65% through the first quarter of 2023. So what are companies doing to get cash? So if VCs are pulling back or being stringent, there's no exit market, there's no debt market. How do you actually raise capital for your company in these troubled times? And then we also see that, again, this is more the healthcare sector, but, VC dollars and deals are again still down. And the problem that we're facing is that myself, even as an investor, we have a large portfolio of 38 companies. We're focusing on our portfolio. We're not actually doing too much investing in new rounds. And that's what most VCs are doing. That's what the pullback is. So it's not just in the US, but that's here as well, is that they have to manage the current portfolio because they've got to raise cash for those companies. So we're not really pushing towards new capital just yet. And if we are, it's very, very selective where we're going to place our capital going forward. And then, what we're seeing is, even in Europe, we're seeing a real downturn in the economy, and that most companies don't have enough cash to last 12 months. And that's not really a long time to have cash. Because the reality is, you don't really have 12 months of cash, because if you're heading towards bankruptcy or lack of funding, you've got to actually save at least 2 months of cash to wind down the company. So you actually have much less cash than you think. So this is causing a massive problem in the whole VC market of, again, there's no exits, there's no new cash coming in, there's no debt market. Again, how do you navigate these troubled times going forward? So what I want to do today is just give you 5 tips on just things you can do. And some of them will seem really intuitive, but you'd be shocked how many investors and companies don't really do these kind of things going forward. But what we're going to talk about is, the first one's going to be honest from where you are. The second is get your company in shape. The third is get your syndicate aligned. The fourth is consider all routes forward. And the 5, though, is embark with some optimism. We're going to go through each one of these. So the first one is be honest with yourself. One of the things that we find is that companies aren't honest about how they perform. What we don't like as investors, when we go see a company and they've had, say, 2 flat years of revenue, but then they show this sort of hockey stick of revenue that it's just going to go through the roof. And that's not really realistic. What we're trying to understand is really what are the things you're doing to turn the company around, and what actually is your revenue over the next 12 months. And that honesty actually helps the investor. But telling us a story that we don't believe in is almost impossible to get yourself money. And the other issue that you have is that if your sector is performing poorly, in most cases, then the company is performing poorly. They're actually tied together. So, certainly where I work in the healthcare sector, it's not doing all that well. That means most portfolio companies then are struggling. And then how much cash do you really need? So the interesting thing about troubled times, if you're raising a down round or a flat round, you don't have to raise lots of capital. What you have to raise is just enough capital to get you past that little bit of a downturn, and then raise your up round. The problem is if you try to raise too much capital in these downtimes, it's really unlikely it's going to happen. So it's just being honest about how much cash you need. And then finally, the valuation. Look, we talked about 21 and 22, these unrealistic valuations that were not supported by anybody's P&L. And if you were having 2 years or a year of down revenue and showing me a valuation that's through the roof, it's just not going to happen, and it's not going to make me believe in the company. And the main tip I'll leave you on this page is that, in the end, hope is not a realistic business strategy. Hoping you're going to get money, hoping you're going to get funding, that is by no means any kind of strategy. You have to be much more thoughtful about how you're moving forward. So next is get your company in shape. Ultimately, you're going to have to ensure that the company has enough cash to move forward and at least some avenue to profitability, which means ultimately you're going to have to cut. And unfortunately, that's making sure that you not only cut expenses, but sometimes it means employees, which is really one of the worst things to do, but sometimes has to be done. But you have to cut to go forward. But the caveat is that you can only cut so much, because you still have to service the customers that you have. So it's a fine line between, cutting too much and cutting too little. But ultimately, you've got to preserve enough cash to move forward. And extending that cash runway is also about, thinking about how you spend money. You only want to spend money on the most essential things that you need to spend money on, and then reserve the cash for future things that you may want to do around expansion or building out your product. The key is survival here. And that's the most important thing, is making sure that you survive to get to that next point in time in which you're going to raise your capital. And then the most important thing is that we tell companies that you got to fix your narrative. And what I mean by that is that tell me a story as the investor coming in, that what is your inflection point that's going to get me excited about investing in your company? And it gets to the point number 1 about being honest. All I want to know is the story, right? You're here, and in 8 months you're going to be here, and then in the next 4 months you'll be here, and that's why you should invest in me. Those are my inflection points. This is how I'm changing and turning the company around. And then I'm going to raise an up round, but you'll be able to, gain in that up round if you invest in me today. So the most important thing that I can leave you on, on this particular tip is that tell me a story of what's your inflection point, and get me excited as an investor to want to invest in you going forward. So the next one is get your syndicate on. This one might seem pretty intuitive, but this one always kind of makes me laugh a bit. Most investors don't know much about other investors that are within the syndicate. Who has money? Who doesn't have money? In an economic downturn, who wants to invest? Who doesn't want to invest? Who wants to abandon the company? Who doesn't care about the company? Who has other priorities? You'd be surprised how many investors don't know anything about what other investors have. The other thing is you want to identify investors early. Look, the reality is if it took you 6 months to raise capital before, it's going to take you at least 12 months now. So if you're looking to raise at the end of the first quarter, you have to be identifying the new investors now and telling your story of why they should come into your particular company. And then check with creditors. We had an instance about 6 months ago where one of the other investors came in and tried to do a full cram down on the company. But we actually own the majority of the debt in the company, and they actually can't do anything without our vote or our approval. And that happens all the time because they just assume that it's the only term sheet coming in. They don't have to listen to anybody, but the creditors actually have the biggest say in anything that happens within your company. So always check in with the debtors or the creditors and understand what their position is on the company. Do they want to continue funding the company, or do they just want the company to close? And then finally, understand the governance. Again, you'd be shocked how many investors don't understand who has the voting rights, who has blocking rights, who owns each class of shares, who are the debtors, what are their rights. You have to understand the entire syndicate and really understand what their position is during these economic downturns. And the most important tip I can leave you here is the whole idea about raising capital is talk first, then raise cash. What I mean by that is get alignment first with your syndicate and new investors, and then really start to really push to raise the capital, because without that alignment, you're never going to raise capital. So the next is consider all routes forward. Everybody assumes like a down round or a flat round is a bad thing. That's actually not a bad thing, because the whole idea is, at least with a down round and a flat round, you're surviving. If you move towards a cram down or bankruptcy, those are the worst options for you, because that wipes everybody out. So you want to start to really think about what are your options. And then ultimately, sometimes the best option is to close the company down. That putting more capital to work actually isn't the right answer. That no matter what you do, you can't save this particular company. That's an unfortunate occurrence, but that is actually one of the possibilities that you should consider going forward. The other thing is, again, reset your expectations around timetables. As we said, it takes much longer in these economic downturns to raise capital. Again, if it took 6 months before, it is at least taking 12 months or longer now. And so talking much sooner to your syndicate and new investors is extremely important. The other thing is you want to keep it simple. And when you're doing a down round or a flat round, and then when it's tough economic times, it's okay not to have sort of any sort of structure in the deal, because creditors don't like structure, and new investors probably don't either. You can always add structure and make it more complicated during the up round, but certainly in a down round and a flat round, you don't want any structure at all within your deals. Make it as simple as possible to get the capital in. And again, as I said, be open to all solutions. You never know what your path to funding could be. Even if the debt market's closed off, perhaps your insiders might want to be able to put debt in, or you just find somebody else, an investor that's willing to put debt in, or it's just a small enough round to buy you a few more months. But consider all options that you have. The big tip on this page is that, look, in the end, dilution doesn't cause bankruptcy. Lack of capital and cash causes bankruptcy. So what I try to tell investors, it's okay to do a down round and a flat round. You live another day. There's nothing wrong with that. What you don't want is that cram down or bankruptcy, because then there's nothing left typically. And then finally, embark with optimism. We were talking about down rounds. There was a statistic that said between 2008 and 2014, 87% of companies that raised a down round were actually able to raise their next round and up round and exit. So that doesn't mean you're sunk. It just means you've bought yourself time to move forward. So it's important not to get hung up on the fact that you might be forced to do a down round or a flat round. Those are okay. It's about surviving. Again, what you don't want is bankruptcy or a cram down. And then at least in healthcare, digital health is actually doing quite well. We're helping improve patients' lives. We're saving patient lives. We're actually fundamentally changing the way healthcare operates. So at least in my sector, I tell people, embark with enthusiasm. And in whatever sector you're in, there's always positives, right? And the whole idea is, keep that positive and optimism going forward, because that's actually going to help you, during these troubled times. You don't always have to be negative about what's happening. So the way I think about it is, yeah, there's all these things going on, but you know what? I got a pretty good portfolio. I'm doing really good things. I'll survive and move forward. But there are certain things I'm going to have to do that are going to be uncomfortable, but I'm going to do it to protect my portfolio and move forward. So in conclusion, here are your tips. For the first one about being honest with yourself, hope is not a viable business strategy. You can't hope you're going to get money. You've got to be really honest about yourself. The second is, get that narrative, in play. Tell me that inflection point that's going to make me want to invest in you. The third is about that, alignment. Talk first, then seek cash. You got to get that alignment or you'll never be able to raise cash because your syndicate's never going to agree on anything. And as I just said, dilution doesn't force companies into bankruptcy, lack of capital does. So what you want to do is explore all paths forward. And again, down rounds and flat rounds are not bad. And again, for me, digital health has never been more important. It's a wonderful place to be. And I bet you all feel that same way about your sectors as well. Again, have that optimism because it actually people feed off that optimism around the industry that you're in. And I'm really optimistic about digital health. So thank you very much for your time. I appreciate it very much. And if you have any questions, you can grab me out in the hallway at some point, and I'm happy to answer them. Thank you.